So let's start with the basics. Every candlestick tells a story. It has an opening price, a closing price, a high, and a low. But in the 714 method, we're focusing on one key thing: the opening price of the candlestick after 1 p.m. This is the candle we use to draw our horizontal line. All right, traders, let's break down this candlestick you're seeing on the screen. Right here at the bottom, this is the opening price. This is the exact level where the candlestick opened when the new 5-minute session started. Now, up here at the top, this is the closing price, which is where the candle finished after 5 minutes. The space between the open and the close, this entire block, is called the body of the candlestick. And then we have the wicks or shadows. This line sticking out below the body is the low of the candlestick, showing how far price dropped during that time. And this one above is the high of the candlestick, showing the highest point price reached before closing. So to sum it up, open is where it started. Close is where it ended. The body shows the battle between buyers and sellers. The wicks show the full range of movement during the candle's life. Easy, right? Let's move on and see how this helps us draw that horizontal line in the 714 method. So now let's say we're seeing a strong bullish movement. Price is pushing up nicely. But before we get ahead of ourselves, we go ahead and draw our vertical line just before 1 p.m. Because this is our focus point, the starting point of the 714 method. Now we patiently wait for price to reach that 1 p.m. mark, and this is where the magic begins. From here, we start watching closely. Is price going to stay bullish? Or will it start reversing and go bearish from this point? Remember, we don't want to jump in too early. We want to observe. The key to the 714 method is spotting the reversal. So we sit back, stay sharp, and let price reveal its direction. This part takes discipline, but it's what separates impulse trades from high-probability trades. All right, so this right here is a bullish candlestick. And what that tells us is that the candle opened down here and closed up here. Now here's the important part, especially for the 714 method. The opening price of the 1 p.m. candlestick is not random. It's actually the exact same level where the previous candlestick closed. That's right, candles are connected. When one closes, the next one opens immediately at that closing price. So now, with that in mind, we draw our vertical line at 2 p.m. Because remember, we're observing price from 1 p.m. to 2 p.m. to decide if the market is bullish or bearish during that time. Everything we do next depends on that movement. Let's keep going. So from 1 p.m. to 2 p.m., we can clearly see that price is moving in a bearish trend. Textbook setup right there. And what do we do when the market is bearish during that time? That's right. We start looking for buying opportunities because we're expecting a reversal. Now don't forget, we already have our horizontal line drawn at the opening price of the 1 p.m. candlestick. And trust me, this line plays a very important role in our setup. From here, we've got two possible scenarios, and this is where things can get a little tricky. The first scenario, which is the cleanest and most preferable, is when price breaks above that horizontal line. That's our go-ahead to buy the reversal, classic 714 method style. Everything aligns, bearish movement from 1 to 2 p.m., break above the open price, and boom, we're in with a high probability trade. Now let's talk about the second scenario. And honestly, this is the trickiest one. So instead of price breaking above the horizontal line, we actually see a rejection right at that level. And this is where things get a bit confusing, because instead of buying the reversal like we'd normally expect, this setup tells us to sell. Wait, I know, you're probably thinking, but weren't we supposed to trade the reversal? What happened to that? That's the tricky part, because this version of the method is all about how price reacts to the opening price. If it rejects the line instead of breaking it, it means the momentum is still strong in the same direction, and we ride that wave. So in this case, even though we started with a bearish move, we sell because price couldn't break above the open. It got rejected. A bit mind-bending, I know, but that's how the 714 method is really meant to be traded. So now, let's go ahead and test both of these theories on a real chart and see how it plays out in the actual market. All right, traders, so here we are again, looking at gold on the 5-minute time frame, just like always. Let's get to work. I'm going to start by drawing my vertical line at exactly 1 p.m., followed by another one at 2 p.m., just like we discussed earlier. Now let's focus. From 1 p.m. to 2 p.m., what's the trend looking like? Yep, you guessed it, bullish. We've got a nice push to the upside. But before we do anything else, let's not forget the horizontal line. We draw that right at the opening price of the 1 p.m. candle. Now here's where things get exciting. We saw price push up, then come back down to retest our opening price line. And what happened? Boom, clean rejection right at that level, and then a beautiful bounce back up. That's a textbook win. So here's the key takeaway. You've got to be patient enough to see how price reacts around the horizontal line. Because depending on that reaction, we either, number 1, buy the rejection like in this case, or number 2, sell the continuation if price rejects and drops. That's the magic of the 714 method. It's not just about spotting reversals, it's about understanding how price moves around key levels. Stick with it, and you'll start to read the market like a book. Let's keep going. Let's go ahead and take a look at another real example. As usual, we kick things off by drawing our first vertical line at 1 p.m. But hold on, I want us to clarify something real quick. Check out the candlestick just before 1 p.m. It's bearish, right? That means the opening price of the 1 p.m. candle will be right down here at the bottom of that wick. That's an important detail to get right every single time. Once that's locked in, we draw our second vertical line at 2 p.m., completing our observation window. Now let's observe price action between 1 p.m. and 2 p.m. What do we see? First, a slight push up, and then boom, price drops aggressively to the downside. So what does that tell us? We got a clean break of the horizontal line drawn at the opening price. And that's our signal to start looking for selling opportunities. But the story doesn't end there. Price pulls back, taps our opening price line again, drops a bit more. And then guess what? It comes back one more time for another rejection before really taking off to the downside. I won't lie, this move was definitely playing with our emotions, but here's the thing. If you stayed confident in your approach and trusted the setup, there were multiple clean entries you could have taken. Every single rejection at that line gave you another chance to jump in on the sell. This is what I love about the 714 method. It's not always one perfect entry. Sometimes it's a whole story unfolding, and you've got to be patient enough to read every chapter. Let me know in the comments. Would you have held strong through that play, or would the fakeouts have shaken you out?